Hey everyone, and welcome back to the channel. We've got some positive movement happening in the mortgage market again, and if you've been sitting on the sidelines waiting for a better opportunity to buy, this might be the early stages of exactly what you've been hoping for. So for the second week straight, mortgage rates have ticked down slightly. So according to Freddie Mac, the average 30-year fixed mortgage rate is now sitting at 6.84%. Now that's down from 6.85% last week and down from or about 6.95% the same time last year. Now let's be clear about this here. These aren't massive drops. I mean, nobody's waking up to find suddenly rates are in the fives again, but it's a move in the right direction, and even a small shift can have a meaningful impact on your monthly payments, especially at today's home prices. But the real story isn't that the rates have come down, it's why they have come down and what it may be signaling for the rest of the year. So let's shift lanes here and break all of this down. Now, the first driver here is last week's inflation report. Now, the Labor Department of Consumer Price Index, or CPI, showed that inflation in May rose just 2.4% compared to a year ago, and the month-over-month prices only climbed 0.1%. That's well below what most economists have been expecting, especially with the new U.S. tariffs coming into play. Hannah Jones, senior economic research analyst over at Realtor.com, summed it up like this. The market expected price growth to rise in response to the U.S. tariffs, so the cooler inflation reading came as a welcome surprise. And that surprise is exactly what helped push mortgage rates lower. When inflation comes in lower than expected, bond yields typically drop, and when bond yields drop, well, mortgage rates tend to follow. The 10-year Treasury yield, which heavily influences mortgage rates, is now sitting around 4.33%, down from over 4.5% just a few weeks ago. Now, this is one of the key numbers that lenders are watching behind the scenes when setting their mortgage rates. But inflation wasn't the only factor working in buyers' favor. The job report also played a role. Last week's employment data showed 139,000 new jobs added in May, and the unemployment rate held steady at 4.2%. Now, this is a healthy labor market, not overheating, not contracting, but stable. In the Federal Reserve, that's exactly the kind of data that they want to see right now. Now, all of this is combining more optimism among buyers and sellers heading into the summer months. Now, Sam Catter, Freddie Mac's chief economist, put it this way: mortgage rates have moved within a narrow range for the past few months, and this week is no different. Rate stability, improving inventory, and slower house price growth are an encouraging combination as we celebrate National Homeownership Month. And you're starting to see that optimism show up in consumer surveys as well. So according to the latest Fannie Mae Home Purchase Sentiment Index, buyer confidence hit a new 2025 high in May. Roughly 1 out of 4 people surveyed said it is a good time to buy a home. Now that may sound low, but it's actually the strongest reading that we've seen since March of 2022. Now, Hannah Jones also commented on this shift, saying recent progress toward more balanced housing market is helping to improve buyer optimism. And part of what's helping improve the optimism is the inventory. In May, the number of homes on the market reached a new post-pandemic high. After years of tight inventory, buyers finally have more choices. And when inventory rises, sellers start to lose some of their leverage. And that's already leading to more price reductions, more seller concessions, and more builders offering incentives like rate buy downs and closing cost credits to help move new homes that have been sitting on the market. Now, with all that said, affordability still remains to be the biggest challenge for a lot of buyers. Now, even though rates have dipped slightly, they're still roughly double what we saw back in 2020 and 2021. So for many households, the higher monthly payment, it's still stretching budget. So while we're seeing improvement, affordability is still tight. But, and this is important, for buyers who are financially ready, the market may finally be opening up to some real opportunities. So let's talk about strategy for a moment. So first, what you want to do is keep an eye on the 10-year Treasury yield. I mean, you don't need to check it every single day, but have a general sense of whether the yields are trending up, down, sideways can give you a little bit more insight into what the mortgage rates may be heading or where they may be heading in the short term. term. Second, work on your credit score. Now, most conventional loans are going to want to see a score of 620 or better. FHA loans, you can technically go as low as 500, but usually that's going to come with a much higher down payment and higher costs. Now, bottom line is this: the higher your score, the better your rate. I know that's a Captain Obvious thing, but it's true. And the less that you pay in both interest and fees. So for every 20, 30 points bump in your score, you can save literally thousands over the life of the loan. So focus on paying down your debts, keeping your credit utilization low, and avoid new credit inquiries and making sure your credit reports are accurate. And then third, consider locking your rate early once you're in contract. Rates have been volatile. One unexpected inflation report, Fed statement, or a global headline can cause rates to spike in a matter of days. So locking in your rate can protect you from those swings while your loan is in process. Now, some lenders even offer float down options if rates drop again during escrow. So ask about these programs. And finally, shop around aggressively. As inventory levels are improving, sellers are becoming more flexible, builders are offering stronger incentives than we've seen in years. And this is one of the first times since 2020 where buyers are starting to get some negotiating power back. The more patient prepared you are, the better chance that you're going to have of finding a home that works for both for your lifestyle and for your budget. Now, before we go wrapping up, let's zoom out for a second and look at the bigger picture that is driving all of this. Now, the Federal Reserve has held interest rates steady for nearly a year now, keeping the Fed funds rate at 5.25% to 5.5%. But with inflation cooling faster than expected, many economists now believe that the Fed may start cutting rates sometime in the second half of 2025, potentially as early as September. Bond markets have already started pricing in some of those expected cuts, which is part of why we've seen the yields start coming down recently and why mortgage rates are following. But there are still headwinds. The federal deficit remains high, and just a few weeks ago, Moody's issued a credit warning for the U.S., citing long-term fiscal risk. That's keeping some upward pressure on the Treasury yields even as inflation softens. So while we are starting to see signs of progress, the market remains fragile. I mean, it is improving, but we're not out of the woods yet. The key takeaway is this: if you're in a solid financial position and you've been waiting for better conditions, this summer may offer one of the better windows we've seen in the past handful of years. All right, friends, and that's going to wrap up this video. Let me know where you're at down in the comments. Are you actively house hunting, or are you waiting for rates to fall further, or are you just trying to build a strategy for when the time feels right? And of course, before we go wrapping up, if you're thinking about buying or selling, I'm a local real estate agent who's called California home for the better part of 30 years. Feel free to reach out anytime. I'd be happy to help you navigate this market that we're in. And as always, hit that like button, subscribe to the channel, and I will see you in the next video.